the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. We deal with the physical market. And yet, as a miner, we sell our ounces. We have to sell our ounces because we're not in the business of hoarding our own ounces. Our institutional investors expect us to take advantage of the current metal prices, and they want to see those revenues and those profits. And a lot of these traders have hit their limits, which I remember going back to 2011, the same phenomenon occurred. But it was so long ago that I kind of forgot about it. But now, as a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system.
Silver prices fell below the critical support level of $30 during Friday's New York session, following the release of the May United States Nonfarm Payrolls report. The report indicated strong labor demand and unexpectedly high wage growth, contributing to the white metal's sharp decline. KeithNeumeyer, CEO of First Majestic Silver, attributes the recent volatility and significant price drops in the silver market to short sellers aiming to discourage investment in silver. He asserts that this manipulation, while disruptive, does not significantly impact industrial demand for the metal. Experts such as Ed Steer of Gold and Silver Digest and the Gold Antitrust Action Committee argue that entities like JPMorgan Chase Co exert substantial control over silver prices. They believe silver prices will rise significantly once these major players permit it. Despite these influences, the possibility of silver reaching its historic high of nearly $50 remains, especially if the metal continues its upward trajectory this year. In recent weeks, silver has experienced a remarkable rally, with prices surpassing $31, despite significant short positions held by central banks. This situation echoes past concerns. In 2010, investors sued JPMorgan Chase Co and HSBC Holdings Public Limited Company, accusing them of manipulating silver prices. However, a 2014 Second Circuit Court ruling found insufficient evidence to prove intentional market manipulation. The court acknowledged JPMorgan's substantial short positions, but concluded this alone did not indicate manipulation. Together, JPMorgan and HSBC controlled over 48% of the short positions in the futures market, potentially leading to a short squeeze. Neumeyer highlights that banks with significant short positions in silver are under financial pressure. Conversely, mining companies like First Majestic Silver must sell their silver production to generate revenue, meet institutional investor expectations, and maintain stock value. Join us as we delve into KeithNeumeyer's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
You saw the smash down in the last couple of days, and that's all, the shorts are trying to dissuade individuals like ourselves to, put money into this as an investment into silver. It doesn't affect the industry because it doesn't cost, for a BMW, whether it's 30 grams or 40 grams of silver, in an electric car, whatever the number is, and it's a highly held secret of exactly how much silver is in any kind of automobile or any kind of device that we consume as a human race, because all these numbers are kept, very close to the chest. But nevertheless, it's quite irrelevant if silver is $100 or $200 or $300, compared to the price of an automobile. The banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. We deal with the physical market, and yet as a miner, we sell our ounces. We have to sell our ounces because we're not in the business of hoarding our own ounces. Our institutional investors expect us to take advantage of the current metal prices, and they want to see those revenues and those profits. And that affects the analysts, and that affects the target prices they put on our stock, and that affects the shareholders who own. We have 80,000 shareholders worldwide. If all of a sudden we have no revenues, then that's not going to be very good for our share price. So we have to take advantage of the current metal prices, which we do and are doing right now. But it's interesting because the bank limits that a lot of these traders have hit their limits. Which I remember going back to 2011, the same phenomenon occurred, but it was so long ago that I kind of forgot about it. But now, as a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system. Because there's a delay from the time we sell our ounces to the time we actually deliver the ounces. And that could be a 30-day delay, it could be 60 days, it could be 90 days. And that difference is financed. And the banks finance that on behalf of the mining sector. And that's a relationship that's been going on for decades and decades and decades. And that's just the way it works. Yet now, those limits have come to numbers that have reached a breaking point. I'm going to spend some time on this topic over the next couple of months and see what can be done from a mining business perspective to see how we can avoid such things in the future. One of the things we have done is open our own mint so we can pull silver out of the banking system. We can talk further about that. But Dunnigan, your question was also on the supply side. I think you had about 10 topics in your preamble, which I should have had a piece of paper in front of me and wrote them all down. But on the supply side, we haven't seen any new supply, and I don't see any new supply. I see less supply.
Silver prices fell by over 3.5% during European trading on Friday, retreating from one-week highs due to active profit-taking, while U.S. 10-year Treasury yields rebounded. This decline comes against a significant drop in physical silver investment last year, which fell nearly a third to a three-year low of 243.1 million ounces, 7,562 tons. Despite the decline in investment since 2021, there has been a notable increase in silver usage across various industries, including AI chips, solar panels, and electric vehicles. This surge in industrial demand has resulted in silver consumption outpacing supply by approximately 20%. KeithNeumeyer, CEO of First Majestic Silver, attributes the recent significant price drops in silver to market manipulation. This manipulation is causing financial strain on banks with large short positions. This situation presents a dilemma for mining companies, whether to increase investments despite delays in permits and the need for substantial capital. Let's get back to the interview.
First off, it cannot be a blip. So for us as a business, the biggest question is, do we increase investment? Because there's a delay. And I talked about the delay in permits. Well, there's also a delay in investment. So, we decide to, this year we're spending $39 million on exploration. We're spending, I think it's $65 million. Hopefully I don't have that number wrong, but $65 million on development, underground development. So this is building tunnels underground to pull rock out of the ground, to take it to the surface, to put in the mill. It costs a fortune to do underground development. You're building tunnels that are kilometers long to go after silver and gold. It'll take about a year approximately to build a 1 kilometer tunnel. And so you're building that tunnel into an ore body that is there because you've drilled it. So X amount of ounces sitting in that ore body. It's going to cost you, $10 million to get into it. But it's going to take you a year to get there. You're counting on $30 silver prices or $2,400 gold. And the next thing you know, silver's $20 and you've just spent all this money to get there. That's no longer economic.
So in the current environment, do you need to, and does the industry tend to need to wait and see how these price levels persist before making that kind of investment decision that would result in bringing on additional future supply?
Yeah, I think that you follow this industry quite well. And when you see, management teams doing resource estimates at, $1,400 an ounce gold or, $1,600 an ounce gold, which we're seeing, regularly now. It used to be 1,200. Now at least they've moved their numbers up. I'm talking about the big gold players out there. It tells you, and it tells the institutions that the executive teams that are running these big businesses aren't bullish on the metal that they're producing. If they would actually do the numbers at spot, the economics of the economics of basically every mine on the planet would all of a sudden become economic. But they don't want to do that because they don't want to be under the criticism of the regulators or the banks. So they're automatically conservative. So they shoot themselves on the foot just by using lower metal prices just to save them. Yet what that ultimately does, it prevents them from making the investments necessary to grow those assets.
Given the recent volatility in silver prices, driven partly by market manipulation and significant short positions held by major banks, How do you foresee the future of silver investments? Specifically, how can regulatory measures effectively address market manipulation to ensure a fair trading environment? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.